Hi, everyone. Welcome to our very first campfire. This is our approach at really kind of re-energizing the webinar format. We think that one of the things that Beeler.Tech is known for are roundtable conversations. And we thought maybe there's a way that we could bring in some people that are experts in the space and can help shine a different facet on a particular topic and then really have a debate around it. Anyone that's watching, I ask all of you, feel free to contribute to the conversation, use the chat, use the Q&A. But we really just want to, at the end of the day, start to working on establishing best practices and making sure people are educated and understand the various topics. The topic today really is around flooring. Flooring has been something we've been talking about a lot in the Beeler.Tech community for some time now. And at the same time, it feels like on a weekly basis or maybe every other couple of weeks or whatever, something else comes out. And again, one of the things that obviously prompted some of this is the trade desk changing or coming out and announcing how they're managing publisher floors, right? And so we figured there was an idea here to kind of get people together, talk about what we know, and coming out of it, I'm looking to answer certain questions that I think everyone should have, which is, how do I test? How do I know that I'm flooring well? What kind of flooring strategies work? Hard floors, soft floors, dynamic flooring. How does that work? What is going to be the evolution of flooring? And what kind of signal are they seeing on the buy side when we set our floors? We know that that's obviously an issue that we all have. So with that in mind, I'd like to introduce someone I think we all know, Chris Kane, the founder of Jounce. Chris is going to present some of the things he just actually covered in one of his reports. If you don't get the Jounce report, you're not following Jounce. You kind of have to be in my world. I think he's done some amazing work to educate. And what I love about Chris, I'm going to one last accolade, Chris, before I hand things off to you. Chris is all about learning, right? And I think that that's one of the aspects of this, of actually getting data and actually figuring out what it means versus positioning. I think that, Chris, you add a level of just valuable information to the conversation. And so I'm going to turn things over to you and I'm going to go backstage. Chris, can you just say something so I can make sure your audio is working?
Can you hear me okay?
Fantastic. Awesome.
Right.
I'm going to leave it to you. Everyone, Chris Kane.
Thank you. So I'll jump right into it. Only other context I'll add to what Rob said is I very much look at the supply landscape from the perspective of a buyer. And we read a whole bunch of research, track a whole bunch of data, but it's all sort of like the buyer's perspective of what the supply landscape looks like. And so as it relates to floor price optimization or floor price management, I've got all of 3 slides here. I figure I can take just a minute to kind of walk through what I think is happening on the sell side of the market. But again, I look at this from the buy side and try to provide some clarity into why DSPs are starting to challenge the utility of the bid floor signals that they receive through the bid stream. I am hoping you can all see my screen now. If you can't, somebody can just hopefully ping me. As I said, grand total of 3 slides. It's all basically 3 variations of the same picture. But I just want to walk through like a relatively simplistic flow to clarify, I think, sort of like the basic business bet that sell side and buy side companies are sort of like grappling with related to floor price declarations. So work an example with me. Let's assume there's an impression available somewhere on the internet where the publisher has a real hard floor of a 20-cent CPM, meaning they truly have configured their ad server to reject net bids below a 20-cent CPM. And let's assume the publisher doesn't do any sort of like smart dynamic management of that floor. It's just simply saying, I truly won't sell this impression for less than 20 cents. That publisher, through a variety of channels, initiates auctions through ad exchanges, indicating a 20-cent hard floor. And the default behavior of an exchange would be to then mark up that floor price based on the exchange's take rate with the publisher. And so just to work some simple math, assuming an exchange has a 20% take rate with the publisher, the appropriate way for that exchange to then construct a bid request and send it out to DSPs would be to declare a 25-cent floor in the bid request. Meaning, if the DSP sends back a 25-cent bid after the exchange takes its 20% take rate, so 5 cents, it would be able to submit a 20-cent net bid into the publisher's ad server, which would just barely be eligible for consideration. I think that would be essentially the default behavior. And now play it out a couple of steps further. let's assume the DSP then receives that bid request with the 25-cent floor. The DSP has a lot of choices to make. And after a variety of steps, the DSP hypothetically identifies 2 campaigns that are eligible to bid into this auction, meaning they meet all the criteria for the characteristics of this impression, and that their pacing schedule would say, okay, they're eligible to bid. Campaign A hypothetically values the impression at a 50-cent CPM, and campaign B values it at a $5 CPM. Campaign A's daily budget is $1,000. Campaign B's budget is $100. The question here is, what bid comes back? What does the exchange receive from the DSP? And the answer, maybe counterintuitively, is campaign A bids. The DSP would select campaign A with very, very high probability. And the way to think about this is the DSP's requirement is to fulfill the budget of both of these campaigns. Fulfilling the budget of campaign A requires purchasing 2 million impressions a day. $1,000 at a 50-cent CPM works out to 2 million impressions. Fulfilling campaign B's budget, $5 CPM, spending $100 at a $5 CPM requires buying 20,000 impressions. And so the DSP needs to buy 100 times more impressions for campaign A than campaign B. Further, it's harder to win impressions for campaign A at a 50-cent price, and it's easy to win impressions for campaign B. And so if you need to win 100 times more impressions for campaign A, you might need to bid 1,000 times more often for campaign A. And so the probability that the DSP selects campaign A is at least 100 times, probably more like 1,000 times more likely than the probability that it would pick campaign B. And so that's sort of our default scenario here. If we modify this, let's say the publisher continues to operate its auction with a hard 20-cent floor, but the exchange does something to modify that and issues the bid request to the DSP now with a $1 floor. Well, now campaign A is no longer eligible if the DSP is respecting that floor price. And the DSP now only has one eligible campaign, campaign B. By changing this floor price with like a huge double underline, if the DSP is respecting floor price declarations, this exchange has now brought a radically higher, 10x higher bid price back to the publisher. I think people who follow me will talk about a whole bunch of sort of like subtleties around this. I'm sure in the discussion we'll sort of like debate the degree to which these modified floor prices are helping or hurting the industry, good for publishers, bad for publishers, good for DSPs, bad for DSPs. My hope is just to clarify, like, I think at its core, what I just walked through is the reason that exchanges and in some cases publishers are modifying floor prices to not represent a hard floor. And I think is also the reason why many DSPs, at least some DSPs, are reaching a conclusion that they should not rigidly respect these price floors and should, at least in some cases, submit bids that are below the floor price that's declared to them in the bid request. So I'll stop there. Rob, back over to you.
Great. Thank you, Chris. That's great. I think you've really kind of set up the stage well for that. So we can dive into that. So our next guest that we're going to have speak, Chris Francia, who is the head of media product at Chael. I'm going to turn things, and Chris, if you want to come up and talk through your perspective and certainly add to what Chris Kane has been able to bring up. Chris, come on up.
So kind of building on what Chris has provided, I'm going to be talking a little bit more of what we see from the agency level. And what we kind of, in my career, where I've been at the publisher level, I've been in the middle, and now I'm at the agency level, of kind of what we know to be true based on our own information and research. So the different markup models, which Chris touched on one already. Model one you'll see here is, the publisher has to deal with the SSP. It's usually based on an invoice percentage. So the SSP is not actually manipulating the floor at all. They just pass it through. The DSP bids. They give the bid wholesale back to the publisher as given. And then at the end of the month, they take their 20% off the top, 5%, 10%, what have you. And then you see at the bottom here, publisher earned how much, SSP earned this much. As we go into markup two, which is what Chris talked about, this is more, I think, common, where the floor price is marked up in auction. and then they take their bid and then they deduct it. There's nothing really right or wrong with any of these. These are two different models, though, how floors are changed or altered and how bid prices are changed and altered that have to be looked at. And which model you're in depends on the SSP, depends on your scenarios and where you're located sometimes. There's also a third model, which does occur, and it occurs more than people think. I call it the banded auction, because what this model is, the SSP passes the floor through without change. The DSP may give multiple bids, and in a first price auction or second price auction, there's lots of manipulation that can happen here. The SSP sees a bid is $2, but they know the publisher is only asking for $1. So they're going to make a guess of how low can we bid to win that inventory from the publisher so we can keep the rest of this money. And in this case, the percentage is not clear. The SSP doesn't really tell you how much they take. You're just, as a publisher, just told what your take is. This is how much you're getting paid. That's it. And it's kind of very black box. And I'm sure some of you are probably thinking, oh, I've been wondering, it does occur. How often, where it's not always that straightforward. From the buy side, from us as an agency, when we're in these platforms, we don't see that much. We know floor prices can pass through, but they're only seen by the systems, SSPs and DSPs. And as Chris mentioned, DSP can choose to ignore it. So can SSPs, or they can add a floor even if a publisher didn't create one. It can be changed whenever. We have no way of knowing if it's been changed. So we don't see floors. We don't really know if we're in a first or second price auction. Most of the time with DV360, it doesn't tell us. And we don't ever know how much the publisher gets paid. And even if we are told, we have no way of verifying it. So there's a huge kind of curtain between us and what happens after the DSP as an agency in terms of reporting, in terms of metrics. And finally, you can see some of the ways that we can actually decide how much we're bidding. We don't have a lot of controls at the agency level in DSPs. We can set a goal, which is kind of how it decides how often we should bid, maybe based on kind of what Chris was showing. We can choose whether to let DV360 decide everything for us in terms of what amount we're going to bid to fill our budget, or we can control the bid ourselves with like a fixed bid, and that means we'll always bid that price and there's no change to it, which is almost never chosen because the amount of work to make that work and effectively is extremely difficult at scaled campaigns when we're dealing with thousands of campaigns running at a time. So you should do some kind of max CPM or some average that we're targeting towards. And that's all we get to do when it comes to pricing. There's no floor price information here. We have no idea what it's being compared against or how it's decided in terms of verifying it. We just have, theories. So this is kind of what we see at the agency level in terms of how floors would impact bid pricing. Is it really ends at the DSP, and the DSP controls what we end up bidding on, and we don't know that logic, that algorithm. It's never transparent to us, the agency, at any system level, and there's almost never a way for us to really verify anything we're told. So that kind of gives you a very high level idea of what can go on and does go on inside the ecosystem as it relates to the floor pricing to bid pricing.
That's great, and believe me, you've given us some meat, some things to dive into with that explanation for sure.
Right.
You head back, and Tom, it is time for Tom Toscari who is a programmatic economist. I got a chance to actually meet him last night. It was great to actually, Tom, meet you in person. You're also going to be speaking at Navigator, so I'm looking forward to that. Tom, if you want to come to the front, I know you have an even different facet of this that you would like to cover on. Tom.
Okay, so really great setup from both Chris's. So I take this from a slightly different angle, from an econ point of view. So when I first saw the news that Trade Desk was doing this, I thought, well, that's kind of interesting, and then a couple things conjured up in my mind. So I'll just preface all of this by saying all of this, when I think about the world and I think about programmatic, I think about a couple things. One is, what do you want and who is you? Typically, we talk about it from the advertiser perspective, but there's other participants in the supply chain that have different incentives and different financial needs. I'll get at that in a second. And then what is true about open web programmatic, but meaning specifically prices and ad quality, because with prices and ad quality, you can get to a value equation. And then you practice what is true to get what you want, particularly obviously if you're the advertiser. So an example of this would be of what is true. It's really a probability question. So for example, prices that advertisers pay are generally observable in DSP data, but what about the ad quality you get after you buy the impression? And that's something that's less observable in the data. Like what is the ad quality definition? What's the ad quality score? This is something that's not generally observable. So it's very difficult in a bidding environment. If you can't value something, meaning based on price and the thing that you're getting, the quality that you're getting, then it makes it very difficult to bid accurately. Now, if you just think about it from the SSP perspective, this is Magnite and this is PubMatic. Magnite in blue, PubMatic in gray. These are comparables. Magnite's never created operating profits and unlikely ever will, given the financial modeling that I do on both of these companies. PubMatic's a little bit different, and it has generated an operating profit that is declining though. And I think to Chris's presentation that he just did in looking at that Bandit auction, I wonder if PubMatic is one of those that participates in Bandit auctions, just because there's a striking difference when you look at the financial performance, when you start to break down ratios in between these two companies, and you start to ask yourself, why is PubMatic performing so much better? They don't disclose take rates, Magnite does, and so we don't know what PubMatic's take rates are, but there could be some really interesting things going on there. Needless to say, cheap reach. So everything's relative. So when Chris Kane talks about cheap reach, this is just a relative view. This is where mobile banner ads fit. They sit in this, $1 to $3 range, and even online video, which here shows a little bit higher, about outstream, instream, et cetera. It's still going to be relatively low price compared to other types of inventory that advertisers, other alternatives that they have that might come with better quality guarantees, et cetera. But for this particular talk today, we're in the open web programmatic world, generally talking about display inventory. So here's when I saw the news on Trade Desk that they were bidding below floors, I said, okay, it's interesting what's going on. So if you think about it, there's a demand curve and a supply curve for everything. In this particular case, we're looking at the demand curve for cheap reach. So there's a demand curve for everything. So there's a demand curve for CTV. There's a demand curve for linear TV. There's a demand curve for any good that's out there. In this case, in programmatic, generally speaking, when we look at the budgets, when we look at the 90 billion market size, meaning money that leaves a DSP, we're generally describing a demand curve of cheap reach. And we know that because for folks out there who see a lot of data, that the average prices are quite low. For example, what I just showed on the last slide. And then you have also, if there's demand for cheap reach, then, you're going to have somebody who's going to come supply the market with cheap reach, which comes in a lot of different forms, made for advertising being the most recent sort of example that's been out in the public sphere, throughout the summer. So then you have, so basically you have this market equilibrium. There's a price that you pay and there's a quantity that it's moved through the system. And what happened, I say really since June, but even before that, and generally speaking, over the last couple of years, there's more and more pressure on marketers, on the ecosystem for a flight to quality. And so what that does is, to the cheap reach supply, you're basically limiting, you're reducing, you're shifting the supply of cheap reach backward. And what happens when in that case is prices go up. That's a really difficult scenario when, on the other hand, you have procurement saying, look, no, we're capping the average CPM that we want on these campaigns. And all of a sudden, when the price goes up, it goes above that cap and something has to happen. As you can see here in the gray box, that would be the amount of revenue loss when supply is shifted backward, a reduction of supply into the market. And so Trade Desk and other DSPs might say, wait a minute, this is actually not great for us. So what do we do? Well, if you start bidding and ignoring floor prices, it's such an interesting scenario because the buy side is actually artificially bringing the supply curve back down to where it was before, so that they can maintain those prices that both Chris has talked about earlier, and the quantity moves back to where it was before. Now, a couple weeks ago, Chris Kane gave a really great webinar on inventory constraints and challenges, opportunity in diverse owned media. And there's something very interesting going on there as well. So we'll just talk about that in a second. It just provides another example of supply and demand. So you have demand for diverse owned media, which has really, really been on the upswing the last, say, 2 or so years. And then you have the supply of diverse owned media. And all supply is finite, all supply is limited. And so what happened was the demand shifted way out. It would normally cause prices to go up and the quantity to move outward as well, because there's a lot more demanded and someone has to supply this. But when you're constrained, when your campaigns are constrained by a CPM cap, even for diverse owned inventory, all of a sudden they're saying, look, we don't want to pay those prices. We want to pay the price that we thought we were paying. But demand shifted outward and raised prices. And so that leaves potentially, and there's evidence of this, Chris, maybe you can talk a little bit more about this, Chris Kane, that is, that what happens is it forces then the inventory owners to say, well, I need to do some audience extension. I need to find some extra reach to satisfy these campaigns at the price that buyers actually want to pay. What happens then is supply then shifts out. You have even more quantity into the exchanges and the price goes back down. So that's all I have on this today. But this is a secondary example just to kind of highlight how supply and demand in these markets likely works.
Tom, thank you for that. And stay up here on stage. If I could ask all the entire panelists, the whole group, to come on out here, and let's keep the conversation going. So come on out, everybody. I'm going to kind of do this as people kind of jump on. So we saw Tom and Chris. We've got Mike Barnaby from PubX. We've got Justin Wall from Salon. We've got Petri, who is from Relevant Yield. We've got Lila from System One. Got Steve Mummy from AccuWeather, Alex Mason from Ranker, and Emery from You know, it's so funny, Emery. I just literally twisted myself up as I was phonetically working that out. I screwed this up. It's
Unwind Media. Unwind
Say
Media. Unwind
I should have
Media.
gone for that. But you know what it is? I thought I could say the other one. And
I thought you were going to make a joke about twisting yourself up, but you need to unwind.
There, thank you for saving
Right.
me. And of course, we have Rebecca from Forbes. So thanks. And again, I'm encouraging everyone that is. Oh, we got Kyle. Here he is. Encouraging everyone to use the Q&A feature, use the chat, and so forth. There were a number of things there that we kind of covered on that we could certainly dive into. Tom, you threw something out to Chris Kane. Chris, I didn't know if you wanted to react to that particular piece in terms of what you're seeing. Tom, I don't know if you want to reiterate that question.
Yeah, it was just on Chris, when a couple of weeks ago, the webinar that you did, it was really great on, looking at diversity owned and looking at that one little piece that was for certain, I think, longer tail publishers, like that, you got to kind of watch out what might be going on there, just because if the demand is 10x the supply, then, and you still as a seller want to satisfy those campaigns and that demand, you may have to go find some inventory.
Yeah, just to kind of add a little context to that, I'm not sure it's specifically connected to floor prices, but we publish monthly research. Our most recent research report was trying to put some math around the size and the composition of the supply landscape of diverse owned media businesses. And what we're basically saying is like, look, there's a handful of individually scaled standalone publishers, Unwind is one of them, that have diverse ownership. There's lots of independent content creators who are essentially one-person LLCs who tend to be represented by Mediavine and Raptive and a few other sales houses. And that if you sort of like draw a circle around like a handful of big publishers, the major sales houses, that winds up getting you 90% of the supply landscape of diverse owned media, at least in the US. And then I think what Tom was touching on is like, all right, well, what's the other 10%? The other 10% is a mixture of individually teeny tiny standalone publishers that, in my judgment, are going to have a really hard time sort of like cutting through the noise of the industry, and publishers that do a lot of ad arbitrage, where they try to like inflate their size artificially by buying a lot of traffic. So happy to talk about that in more detail.
Yeah.
But we're basically advising buyers like, there's a lot of risk out there. Buy from trusted sellers.
Yeah, and that was just an exact. Yeah, well, back to the subject at hand. It was just another to provide the example of supply and demand, and when examining, the space.
Which I think is kind of the core of where I wanted to go with this. And again, I'm looking to this group to help steer on this, right? Which is, when we think about just, would say, the standard thinking ways of thinking about supply and demand, well, when you start to restrict supply. So let me start with this. To me, and again, if anyone wants to disagree or help educate my statement here, right? The one thing is that as a publisher establishing and setting floors, right? We can talk about some of that strategy. You're signaling to the market that you want a certain price for your inventory, right? Without that, again, you're basically letting the market decide what you're worth, which is just not great, right? That doesn't allow you to invest, doesn't allow you to create more content. You're kind of, well, we're good now, maybe we're good tomorrow. We don't know. The market has that. So flooring to me is an essential strategy and is a signal. We put that signal out there with the hopes that it reacts. But the buying space on all of this and just their economics is they are wanting lower CPMs. They want that downward pressure. And I think that there's this aspect that, again, in a fully transparent ecosystem, you're able to say, I want this price. You can come back with it and we can negotiate and we can make that work. But the way that our ecosystem is kind of built, we're sending a signal that Chris Francie is not even seeing, right? The agency is not necessarily getting that. It's just the DSP. And then the DSP is reacting to that and going like, in the benefit of my client. So again, everyone in their own self-interest is going, let us push back on that, right? And in this case, ignoring it in some cases, just flat out not there's no discussion there or whatever. And so to me, that seems to obviously create this thing of, from a publisher perspective, how do I have a flooring strategy where I'm like, I want to signal to the marketplace that I have value, and the marketplace, we're just going to ignore that. And I think that there's some aspect of that I just sit there and think need to be kind of part of this. But I'm happy if anyone wants to react to that or anything from our other people. Go ahead, Chris.
Yeah, I mean, I think on that is something I've noticed happens a lot is the SSPs really control your fate here, and their goal is to get as many bids from DSPs as possible in a given auction, because that raises the level of competition and gives them the best chance of getting a higher bid. So you may set a floor. It could be a hard floor, it could be a soft floor. The SSP's goal is to get as many bids as possible. So many SSPs don't ever submit the bid to the DSP with the floor request in it, solely because it would limit what buys are coming, and then they want that data. They want to see what bids are coming from the DSP, so they can see what inventory and demands available from that DSP. They want that data, so they want to take that, and then they look at it, see the bid prices, and compare, and they'll respond with a no bid if nobody met your floor. But they still sent the bid on to the DSP solely for the data itself. It's valuable to them. That is something I know I've seen in practice quite a bit as a strategy where the DSP doesn't get a floor. I've also seen the reverse where the SSP marks up a floor. After they've done that, they then start marking up the floor, trying to see if they can see what the bid cap is, what that max bid would be, so they can get as close to it as possible to get the most money from that DSP. And when you think about it that way, it makes a lot more sense why DSPs are not very trusting of floor prices in their algorithms, and they're starting to ignore them because it's not the best interest of the SSP to adhere to them, because it goes contrary to their philosophy of understanding what the max bid's going to be. And the less data they get, the harder it is to do that. So that's just something I've seen in the tech itself as a strategy that is employed and is valuable to the SSP.
So if they get the flow, they just don't know whether they even believe it. I get that. Someone else, let's get some other voices into this. What are your thoughts based on what you've heard? What does this mean? What are your questions? Who wants to go first?
I'll jump in. I think it's really important also to establish like the floors we're talking about being open exchange versus your PMPs and them being one-to-one. I think there's really nothing better than when an advertiser or agency comes to you and is like, hey, I'm not scaling on your deal, and you get to say, it's because I'm sold out of something, or you need to bid higher, and they actually agree and start doing that. Not a lot of people have that ability, and a lot of folks do have a mostly programmatic business. At Ranker, we're doing a lot more direct and a lot more PMP stuff these days, and kind of having a team to really value your inventory and your most premium inventory, and literally set this baseline. Like, I think that my one-to-one inventory is most valuable at $4 or $5, the lowest, because agencies and these advertisers are buying it to get that priority. The more you have of that creates that really good supply and demand structure where you can go back to advertisers. And then at that point, the open exchange below it, in some cases, especially when you're really sold out, you don't even have to think about a floor because the market is naturally competing to get a higher bid. So it's really important to kind of, I think, establish the PMPs, one-to-one deals versus open, because those strategies alone are going to be different and helpful to a publisher.
So, and this is somewhat obvious. I want to get, sorry, just one thought on that, just because it makes it, in my mind, to what you're saying, is there's this aspect of the larger strategy, again, of how you go out to market with your inventory. And if you have the means, right? So let's just add that little qualifier. The fact of the matter is that if you do set up a PMP, PG deal, you are talking about the fidelity of the signal as you as a publisher to the buyer is then clear, and they know what you're pricing it at, and you have that conversation. So really, that's the best way to signal the market. After that, when you get to the open marketplace, again, you're sending out this signal, and as we're seeing, that signal is not either received or potentially manipulated, and we have to kind of talk through some of those pieces. Someone else was going to say something. Was it Tom?
Yeah. So to Alex's point, it's really interesting from the publisher strategy. I think the publishers do get there's a certain fundamental that most publishers are getting wrong. So in business, there's a thing called profits, and profits are revenue minus cost, right? It's that simple. But also, the key thing that you want to do is you optimize revenue to maximize profits. When you look at what's going on in an ad server in a publisher's business, they're trying to maximize revenue, and that's a mistake. You want to maximize profits. In other words, sometimes you can overshoot revenue and it actually comes out to be a lower profit than if you just optimized revenue to it's like a rainbow. You want to hit a peak in your optimization where profits are optimized at a certain level of revenue. So they all basically, I see them making this mistake all the time because they're making these business decisions, technology decisions, people decisions based off of what is just a wrong fundamentals, right? So everything bad begins from that. But then to Alex's point, what you really ultimately want to do, and it depends on the size of the publisher and their resources, you want to sell out as much priority for inventory as you possibly can ahead of, and because why? You're creating this thing that I would just call dual scarcity. So you want to sell out as much inventory as you can on a direct insertion order priority 4 basis, whether it's a PG deal or direct insertion order, whatever it is. It can go through programmatic pipes or not. And that diminishes the amount that's left over to go to auction. And then what that means, you have a finite inventory. And as he said, if the market is really valuing your stuff, you're creating this scarcity. And even if you have no floor prices, your inventory is going to be in demand because it's performant, right? And you don't have to worry about it. You won't have to worry about it at all. And that to me is the best approach. But you don't see these best practices in publishers as much as you would think you would see them.
Yeah.
I'm very confused about something you said, which is we're not optimizing or we're not maximizing profit. I don't know a single leadership here on the pub side that is not constantly thinking about the profitability of their business. So I'm sure there's just a disconnect between what you're describing as like the commonality you're seeing, this gap you're seeing, and what we're trying to do.
Okay, think about it this way. I think from the entire publisher business, I could totally see that from the CFO down. Within just what gets sold programmatically, and you think about the people, the processes, and the technology that's in play, right? Just within your programmatic stack. What is the P&L within just that world? And it just observation suggests that how decisions are made within that world, it looks like a lot of revenue maximization which could be not fully optimal from the profit perspective of just the programmatic slug.
Okay, there's a cultural thing that's fueling that, I think, that is a much bigger issue, which is publishers are terrified they're not making the most money possible.
Yeah.
And so we're constantly making decisions. And somebody said this to us recently, Emery, of like, well, if it's making me more money, then why wouldn't I do it? And there's a lot of reasons for why we wouldn't do something that makes an immediate dent in that CPM. The biggest challenge I have is that short-term like CPM dopamine hit versus the long-term market impact of the decisions we're making on a regular basis. And we don't really have I think partnerships within our vendors to be able to understand the impacts of the things we do or that they do. And it's not, I don't think it's like a lack of business acumen or strategic decision making. It's literally like everybody's on a rev share model. Everybody's going to tell me if I don't do this thing, I'm not going to make more money, or I need to do this thing to make more money. And the split testing kind of just structure that we're all dependent on is in the moment, I made more money here than here, and so we're going to do this thing forever and ever and ever.
It's just throwing more coal at the fire, into the fire as much as you can. Just keep throwing coal, whether you're moving or not, right? Chris Kane, it looked like you were signaling. I don't know if I misread the pop. No, okay. I thought you gave me a subtle hint. Someone, please.
So there was something else though about what you guys were saying is like with direct sold and the entire business. So like a lot of DSPs, what they're looking at is like win rates. And so like as you have these win rates and you're bidding against things, you're losing. DSPs are going to kind of look at you as like as a priority or a less priority kind of place, because like if you're fully directly sold out, you have all your header bidding, you're bidding through AdX, you're bidding through TAM, like you have a low win rate. Like that's not necessarily a good thing. And then also there's things that even with Chris said, like as you kind of like reduce your supply, like there's a thing that Chris has come out with multiple times is the more like requests you make out to the DSPs, the more responses you're going to get. And to some extent, I believe that, but like Chris's data definitely points that out. Like the more auctions you send out, the more you win, like the more demands that's going to come through those things that's going to come to your site. And then also when you're kind of looking at like floors in general, like setting an arbitrary floor, like, hey, I want $4 for this, like isn't necessarily like a great way to look at it. Like they're obviously looking at viewability and clicks, and like you have to kind of be able to price your floors based off of like how it actually performs. And that's really like what people are kind of looking at. It's going to be very different for every publisher, everything on the page, each individual, almost pre-bid partner, and then even an AdX on top of that.
I think that's
sorry. I was going to say, I set all my floors off of CPCs, because if I know somebody's getting clicks off of my inventory for 20 cents, then I know that they're willing to pay more, and that's what's informing my floors. And sometimes that translates to like a $10, $15 floor.
Yeah.
One thing I want to clarify here, which I feel like I didn't maybe get through as clear as I wished I had earlier, is that what DSPs are observing, and we're trying to collect some better data about this, is that the floor price that the publisher declares has only a pretty loose correlation with the floor price declared by SSPs in the bid request that they send to DSPs. And so there is no reliable signal in the bid stream of what the publisher's actual floor is. And I think that is an issue that should be an issue for publishers, that like the floor you set has only a loose correlation with the floor that's transmitted to DSPs. And of course, that's a problem for DSPs because the floor they receive is not a reliable signal of the publisher's actual floor price. I think that's like the guts of what the trade desk's public discussions over the last couple of weeks were about.
But Chris, I'm dependent on that. Sorry, I have one more thing and then I'll stop. Like I'm dependent on that because the whole fact that I have, let's say, 12 SSPs all throwing out auctions and God only knows where they're throwing auctions to at different floor rates means they're bringing back bid diversity, which means I have the ability to retain like a market pressure for my inventory off of the way they're all differently approaching the auction that should be in theory self-sufficient, right? So if I'm not trading, like flooring the trade desk directly as OpenPath, well, they still have to clear what everybody else bid. And that's the only thing that's holding like that we're holding on to.
I'm totally with you. But like this to me is like the interesting part. Like you just framed that as like the diversity of SSP partners I have with the diversity of techniques for managing dynamic floors is a business benefit to System One. And I'm like monitoring the chat over here, and like someone else just framed that exact same thing as a failure of the SSPs. And it's like, well, which is it? Is that the SSPs misrepresenting your inventory to buyers and not doing their job? Or is it the SSPs actively managing the behavior of buyers to bring you back the richest demand that they can? Like, I don't feel clear on that, but like that's the debate.
I agree that's the debate, but before that debate, as a publisher, I think it's important to define sort of why. Well, like the challenge is publishers' approach are going to vary one-to-one. Everyone has a different approach. Every publisher participating in this call has a different approach. But to take a step back, when I think about flooring as a publisher, I think something that Tom said holistically is really important, thinking about floor pricing, and that was what is true. So as a publisher, what do you know is true? And what you know is, one, internally how you feel you should value your inventory, but that's based off signals that you believe based on bid responses, or have value to the buy side, right? And those are things like geo, device. And I think it's important to define, like, we're going to get into the weeds of some of these floor pricing strategies, but as simple as this sounds, publishers need to think of their inventory as their product and carving out that inventory as their product lines. Now, if we're focusing on those things, then we get a very clear signal back if we're looking at log level data or bid responses in terms of how those different signals are valued differently, right? And it's as simple as is a user on Chrome or is a user on Safari. But if you're controlling what you can as a publisher, you're setting up these segments around things that have value. And I think what's interesting about what Chris and Lila are debating, I'm in the camp, I set a dynamic floor for every bid request that goes out. So the question Chris is asking is, Lila, sounds like you're relying on some level of optimization from your SSP. I don't want any optimization from my SSP because we've put a lot of work into finding the signal that we want to push out to not one, but all participating partners. So when I read what the trade desk was doing as a publisher, I'm not going to adjust my floors based on that, because I'm sending out an individual floor on a session level to all of my participating partners. And that's what I want to happen. But I feel like that's where this debate gets very complicated.
You have the truly unified auction, whereas I have the
I
have the most
because
fragmented you could possibly find.
Well, I guess, yeah. I mean, that's well said. I hope to have a unified auction, but I bet if I work with Chris to see what the DSPs are ingesting on my behalf, my bet would be it's not unified because it's being changed on some level, but I didn't request it to be changed. Right. And I think that's really hard.
I think it also depends on, like, if you set pre-bid floors or if you're just telling the SSP, like, I want 20 cents. And so, like, I'm guessing if you use pre-bid floors, like, those should get passed through to the SSP and those should get pushed out. And the good thing about that is, like, if anything comes below those floors, like, those get dropped instantly. They have no chance of winning. Nothing's going to happen. There's no reason for them not to do that. But if you send a 20-cent floor, like, then they can kind of do whatever they want. And that's, I think, where this whole thing kind of comes into play, is when you're not adhering to the floors and they're allowed to do kind of whatever they want.
To that point, sorry. To that point, something I can tell you that we absolutely have seen is when you're telling the people who decide your margins, the information of the floor, like in Google, whatever, when they control the whole ecosystem. So I'll use Google as an example, not accusing, but just as an example. If you tell Google you want at least 20 cents for your inventory, and Google thinks it can get it for $5, they will do what they can to get it for $5 and give it to you for just about 21 cents. That's where the bandit auction comes. When you give them that information, the temptation to manipulate that auction, and maybe they don't do it all year round. Maybe they say, oh, it's December. Let's do the bandit auction just this month to boost our numbers in the quarter. We've all seen buys go up at certain times of the year in a month very regularly. It happens to go around quarterly earnings. so it's not, they may say we do 20%, we do 20%, we'll do 50% this month. It's very tempting to tweak that because there's no watchdog. Nobody, again, buyers have no idea. We don't know SSP rates. We're not told that take rate. So when you're with your pre-bid, you have definitely more control. When you're just telling the SSP, you're giving them more power to be a little more temptation for them to mess with how their take is going to be.
So
Yeah.
Sorry, I was just going to say I want to make sure. So there's an aspect of this that the takeaway at this point, obviously, and again, the most obvious statement of so far of the day, right? Of this complexity and lack of transparency. We need to work on that, right? Let's again, publishers are putting value on their inventory that should be communicated. To Emery's point, it might be I want to, as the publisher, set that, or I might look to the SSP to help me optimize that. But there needs to be some piece of that we have to kind of work through. I want to start to transition into what can publishers do in terms of some of these strategies and dive into that. Before I do that, I do want to throw it to Petri because we had a conversation yesterday, and I wanted to ask you about SSP performance when the DSP is bidding kind of close to that floor. You've observed something with what you do. Can you speak to that?
Yeah, happy to do that. I don't know yet what we have learned, but something, and at least seen something. So what we have been doing is that we have been running kind of like an end-to-end test. So we have been using 2 DSPs, and then on the other side we have had 8 SSPs. SSPs offering the same inventory, and the idea was to see that how does it work when we are bidding into DSP, like the price, like a 1 cent above the floor, which is set on the publisher side. So just out of curiosity, and it's the one question raised that is that why only 3 SSPs from 8 are able to perform for those like campaigns. Only 3 SSPs are able to sell something when the DSP is offering like the bid is like 1 cent above the floor price. And then we have been continuing like increasing the price on the DSP side, and now we are like 20% on top of floor, and still it seems that not all SSPs are like picking up. So we are not definitely saying that there's like anything shady behind that. Most likely something technical issues or IDs missing or supply path optimization or whatever, but still quite fascinating and interesting to see that
to just watch
what happens. Yeah.
Great.
Do you have like would be great to hear like others' opinions or learnings that.
Any take on that, guys? Anyone?
Just like I said, so your test, you saw only a handful of SSPs. Actually, your bid was able to hit, despite you selling to multiple SSPs from your pre-bid side. Yeah, we see this all the time, and many SSPs sell to other SSPs. They say they have demand, but they don't. There's only so many DSPs out there. We have, I don't know what our budget is. We're in 45 countries spending hundreds of millions of dollars a year in media. We probably across our entire network only use 5 DSPs outside of like a very country specific, like 5 global DSP. So when we buy, I don't think I've ever seen more than 4 or 5 in a given day of SSPs, and usually one of those is Google, and then the other ones is a mixture of programmatic, Magnite, and depending on certain regions, there may be others. So all these smaller SSPs, first look at, do they even have a connection to Google? Second, just because they have connection to Google doesn't mean they're enabled on DV360. Each partner on DV360 has a different set of enabled exchanges. So you can look and see they might be connected to Google's SSP, but are they actually enabled DV360? And DV360 has a list you can find, I think, in their API that tells you the SSPs connected. Most of the smaller ones connect through BidSwitch. And you have to get, it's a whole thing, but that's a lot of the reason is, and I'll tell you, we don't bid on BidSwitch very much anymore. We've more or less turned them off because there's no transparency. BidSwitch won't tell you which SSP you bought in BidSwitch. It just says BidSwitch, which it just doesn't helpful to us. So it's only good for PMP deals. But that is why there's only really 3 or 4 SSPs that are actually selling to the DSPs and the DSPs are listening to on the whole. Then there's like category specific ones like Vistar Media for digital out of home, or very specific ones to specific channels, as there for CTV. But any of these holistic ones say, oh, we're great, we have demand everywhere. If they're not one of the big ones, you have to look at it and say, well, who is actually buying? Because agencies, we don't connect directly to SSPs. That doesn't exist, really.
Go ahead, Lila.
Why do I need DV360 outside of AdX? Right? Like, this is always the question that I come back to, because when I look at some of the DSP share of voices from major DSPs, and there's 60% DV360 and GDN, they're basically reselling Google at that point. Why do I need Google resold outside of my already very neatly controlled and well understood Google stack?
You don't.
Thank you.
It is the, if you guys have been here long enough, you remember the old tag days, right? Someone gave you a tag from LiveRail, and you would market that to SpotX, and then that, it's just the middlemen taking their tax. They don't provide anything because they can't really augment it. Google strips it anyways and adds their own Google data. So the DV360, yeah, we have no idea we can select direct only or reseller allowed or none of the above in Google. That's our options. Very few media buyers sometimes even play with that. Some do, some don't. But there's not really, the DS buyers, we have no idea what's going on.
Right, but then when you look at the viability of the companies supporting the ecosystem,
Right.
I have huge questions, right? Because all of a sudden it's like, I've got Google here, Google here, Google here, Google here. Everybody's already got eyes on Google. Google's now has eyes, right? And Trade Desk is now doing this. It's the same thing with OpenPath, where I've got Trade Desk in AdX. Now I got Trade Desk Direct, and I've got Trade Desk through every other SSP. Once Trade Desk is on my site, connected directly to me, and to Emery's point, that's where I'm investing in the control and the flooring and the pricing and the optimization. Everything else undermines that effort. Or am I seeing this wrong?
There's one thing you're missing, and this from the agency side when we're buying, is when we set our targeting parameters, X, Y, and Z, Trade Desk will do its best to try to match you to its open, whatever, unified ID and try to say, we know who this user is. When it goes through AdX, Google, and it hits DV360, you're using Google's first-party audiences, and guess what? Google knows who you are. They are, Amazon and Samsung and Facebook have the largest data sets on users, solely by their sheer size. So if we're doing a demographic targeting and stuff, and Trade Desk couldn't match it themselves, and it's a direct, our target won't hit them because they couldn't match it. With AdX, it could. Now that is a selling point. I'm sure a lot of you publishers have heard some SPs saying, oh, we have special technology that augments the bid and makes it, unless they're one of the people who have that first party audience data, it's not going to be any more accurate than Trade Desk. But that is why AdX sometimes will perform better, and you'll see differences in Trade Desk bidding when we target it, solely for the fact that it can match against the Google audience data.
All right.
Isn't the DV360 question, as far as it performing everywhere, it's kind of the whole, when you go down the reseller path, and as far as having exposure across multiple paths and multiple shots of the same impression, isn't that part of the point here, right? Like, we understand there's traffic shaping happening on the DSP side, we understand there's traffic shaping happening on the SSP side, and now we have publishers doing their own flooring algos on top of it. So you have everyone kind of working independently of each other. On the campaign management side, on the DSP side, there's algorithms to deliver those campaigns. We saw Chris talk about earlier, the higher CPMs, the pacing aspect of it. You need to be able to deliver at an effective pace. You need to see the inventory. So there's times where even though you have demand to bid with, you don't bid. And that's even if you even see the request, right? So from Google's standpoint, having access to all the pipes makes sense. It's the same reason why, from my point of view, in the publisher side, why every SSP wants us to run in OB, in TAM, in pre-bid server, and in client, because it gives them multiple shots without having to give you multiple seats, right? Into the same inventory. Like it seems like that's the way it works.
Bingo. Yeah.
There is a caveat there that there's a depreciating return that can happen with that setup. And that is from the buy side when it gets to DV360, right? Because DV360 is not really connected to ADX in the way, like it's not, ADX just an SSP to it. It's all very,
Right.
even Google systems are not connected. So when it gets to DV360 or it gets to the trade desk and we're making a bid and we're getting all these requests from all these different SSPs at the same time in the same auction. Now, logically, we all know it should be the bid request ID set by pre-bid or set by OB, the starting one. But we've done tests. The bid request that's set does not always become the bid request ID that's passed. And they try to make this, they may have 4 seats in the same auction for the same inventory, for the same slot, and they'll pass it through with the floors or what have you, and it will come to the DSP. Now, the DSP should realistically only see one bid request ID for those 4, knowing it's the same person, same placement. So there's only one opportunity for those 4 different bid requests. But because they all want to maximize bids and get unique bids and increase their bid rates, they make them unique. So the DSP sees it as 4 opportunities in 4 separate requests. Then we bid on it, our buyer, we bid on it, and we win one of the 4. We're like, well, why is our win rate 1 of 4? Well, let's increase our CPM a little bit, which is what the SSP wants us to do. So we're paying more for the same impression. Win rate doesn't change. Win rate doesn't change. And then eventually, like, well, something's really off here, and I don't want to deal with it anymore. We're just going to lower the bid and not touch the site again. And I hear this from our buyers all the time, that why can't, and because win rate is part of the optimization algorithms of some of these DSPs, when win rate gets screwed up like that, it can have an effect. Does it happen everywhere? No, but it can have a negative effect to the media buyer strategies, where eventually we just cut tail and say, well, block the site or bid very low and stop even worrying about it.
But I mean, it's a result of these 2, independent systems that have evolved,
absolutely.
time
The
the way they're
fragmentation is the source of all these problems.
And I mean, it's an argument towards the consolidation there, right? Obviously, it's a different world pre-header bidding, where you had niches you have SSPs that focus on particular niches of sites, and they're like, oh, we have auto intenders, we have these guys, and then header bidding just blew it wide open. Everyone has everybody, and everyone exposes everyone through all the same pipes. So you have 12 SSPs working with the same set of publishers, working with the same set of DSPs underneath, and they all work independent of each other. So it's very counterproductive.
Right.
Yeah.
Time out. So first of all, Prem got added because Prem was adding enough stuff into the chat that I just could not keep up. This is how this is going to work. We're going to just add, if you bring those voices in and stuff like that to do that. So Prem, so thanks and welcome from Freestar. There's a aspect of this I have not been able to keep up on all the chat. So if you had questions, definitely put them in the Q&A. I do want to start to kind of shift the conversation into best practices. Because again, I think what we've definitely established is that the ecosystem around which this is built is complex, opaque, and problematic. And I think that is ongoing conversation that we have to have. And sorry, Prem, yes, I realize I'm one hop behind. But there's a piece of that I just wanted to get into. First of all, I don't know if anyone on this call or anyone sitting there thinking that publishers should not have floors. Like, is anyone thinking like there's anyone going to sit there and play that? There's almost like this is like the mummy moment. This is when Steve goes completely contrarian and tells you, but no, he didn't. He didn't take the bait. Fantastic. I got one thing right. Let's talk about just one of the things that I have two types of questions here. You can kind of jump in on this, which is, well, 3 actually. Granularity, and what level of granularity makes sense. You heard Tom talk about some of that. You heard like there's some pieces of this of going like certainly by browser or country, or like there could be a different level. I'm curious as to where this group falls in terms of their strategies of what is granular enough and what's too granular. I think there's also this aspect of dynamic, and where does dynamic flooring fit? And is there an aspect of too dynamic? In other words, can you send too many changes too quickly into the marketplace and that can work against you? I think that that's kind of it. I just realized there was another facet that I've kind of lost the plot. Anyone want to jump into the granularity and or the dynamic level of this in terms of what you've observed, what you've experienced that you think others? Rebecca, please.
So I think that flooring is important. Oh, my camera went off. I think that flooring is important, but I don't think that it's necessary for all of the inventory. I do not have it across everything. I don't see the value in it, especially if I don't see performance on some of my ads. I'd rather have either testing out dynamic flooring or let the SSP do it themselves. Where I think that value comes in is when we're looking at performance of placements. So whether you're talking about browsers, content, ad placements on the site, like understanding the value of where you're seeing performance and where you're seeing high sell-through on the direct and PG, PMP side, and then being able to sort of push the nudge to help drive that CPM up. So I think that that's where we find value, but I also remember a few years ago where I used to hear that some publishers had 5 headcounts of people just going and changing floors every half hour, every hour of the day, and then bringing it down before the end of the day. There is seasonality to it, end of quarter, beginning of quarter, but to a degree of how much are you really getting out of doing too much. So I think there's a healthy medium of being able to value the ad slots that you have and the content that you have, but then to a degree where it doesn't make sense to overcomplicate it, and then you're just spending, or you're having people that are just spending their days going and changing floors.
It's like day trading, right?
Yeah.
But even more than that.
There's a cost that comes to it, and does the value benefit the time of being able to have to constantly do that? I don't see that.
I think if you're doing manual flooring, you're having someone actually managing it, then you're very, very limited, right? And you have to work within your means. I think the dynamic flooring aspect is where this changes a lot. Now, some publishers, the majority of the traffic is very consistent and it's from 1 or 2 sources, search, and it's organic, and they're done, and they don't really have to worry about it. To some extent, maybe a primary geo, but then you have other publishers that have all sorts of different types of traffic makeups. And that's where, like, I practically made a career out of finding nickels in the couch when you start going into it. So the cohorts that you dive into, granularity that you can go create floors around, both from a cohort point of view, then taking into seasonality and other things that happen, that may not be seasonal, but something that happens in the middle of a week or the middle of a month that's not something expected, to be able to have a system in an ideal scenario that can track and push those floors up when things are happening, recognize that there's actually demand there still to go do so, is a valuable thing in my point of view, especially combined with the strategy with what do you do with now the unfilled inventory, because that is an opportunity at that point. If you push floors too high, yes, you lose revenue. Well, it doesn't have to be that way. If you do nothing, you certainly can, but there's things you can do there to fill that side of it. So it creates yet another opportunity. But again, people, resources behind it, what do you do with it? How do you staff it? Are all variables you kind of have to take into account to go put together a holistic strategy.
Justin, I think I saw you saying something.
Yeah, I did.
Yeah.
Thanks. I think if we as publishers can accept the complexity of what's happening at the SSP and DSP level that have been talked about on the call today, then we have to also accept that our tools are not strong enough to compete. Price flooring works at a point of protecting your bottom line. Don't sell yourself too cheaply, but trying to game it against the strength of the data manipulation that is happening at these tiers above us is kind of a hopeless effort, I think. So I do believe in the idea of dynamic price flooring for publishers, and think that if your ad server was going to say that that opportunity was appropriate for a direct deal or another type of buy, that same logic can help you say this should be priced a bit higher as a floor than other opportunities in a programmatic landscape. But trying to really game it all the way up from 50 cents to $5 is likely a losing battle. So really just accepting what tools are available to us and how much we can really hope to do with them is probably helpful for dealing with the stress of wondering if you're doing enough.
Yeah, Justin, just to build on that a little bit as well on
dynamic flooring, I think you've got to have that consistency in the consistent approach. And I think that's what Tom was referring to when he said, you know, revenue over profit. Know where the profit needs to be and the baseline is, and then use that to channel these dynamic flooring and these capabilities out there. What we need to remember is that every option that doesn't have a floor feeds algorithms across the system, and those algorithms are learning and learning and learning. And something that we haven't talked a lot about right now is data. There's so much data. Having humans on there trying to log in, manipulate, it's the time of day, browser placement. I think in providing you have that, you know where your baseline is, use the tools that are available to increase it where you can. And having that increase will feed the buy side algorithms, the trade desk. They're going to bid below the floor that they see, not your hard floor that we set as publishers. So it's very important that you know where your costs are, you know where you want to be from the value of the ad, and use the tools that are available to scale that dynamic flooring up, which incrementally sees higher bids coming through, and it perpetuates where the floors can go over the longer term.
I just want to make a quick point about dynamic flooring, because it's often, or at least my perception is, it's used in the sense that a publisher is, you know, randomly increasing the bid price as high as possible, and that's not what it means to me. I think about flow when I talk about building audience segments around information, you know. Mike just made this point and Justin made this point as well, but the information we know through a user session is what price that user is clearing at, which gives you a sense of that value. So that's a really valuable tool, and you can use that tool to inform future floors without, you know, pricing too high. And when I think about setting hard floors, that is more about preserving audience value long term, and less about maximizing yield in the short term. And that's an easy thing to say as a publisher. Some folks don't have that luxury, right? We're thinking for the day or the week or the quarter. But I think those two things are really important to narrow in on, which is what is the appropriate hard floor where you're maximizing the value of your audience. What are the segments of your audience that you see in your data return at higher rates, and how do you maximize that value throughout the user session?
Yeah, I 100% agree. And it's all about knowing where you kink the hose and where you let the hose loose. And that's what dynamic flooring has always been about. It's not about changing them or randomizing them. It's just about going, here is a segment that is more valuable than another segment. Lay the pressure on. Because if you let them win, it's somebody was talking about like the DSPs, when they win, they bid. Well, if you let them win, they're going to keep bidding where they are. And what I'm starting to see is the value signals around contextual are already coming into play. You see this specifically with performance marketers who are going after specific verticals and contexts, and the pressure is there, and they do respond in real time to a different flooring signal. So, like, the way I'm thinking about flooring is I've got however 300 IAB categories. All of those categories, based off the different demand pools around them, have different CTRs, different CPMs that are coming through, and that's what I'm looking at for here's where I need to protect pricing versus this is something that has no value. Right now, I've been relying on the SSPs because value comes with the user through their cookie history, and I can't see that. I can't really analyze their cookie history and go, oh, this user has 20 cookies. I think they're going to be worth $10, right? It's just not how it works. But that's going away, and I really am having a hard time understanding, like, the SSPs were providing value here. I know they're definitely doing something because I've seen it when we add new ad units and the CPMs are just not the same, right? What is happening is changing. The way DSPs are responding to the SSPs is changing. So now what are they doing for me?
Yeah.
Right? And do I have to do this myself?
Tom, go ahead, please.
Yeah, Lila, a couple things there. A couple things. One, on that last point, you self-preservation in business is a hell of an incentive. There's a lot of things going on in these businesses, particularly now that they're, well, Magnite and PubMatic in particular on the SSP side that are public, right? And then if you look on the demand side, you've got a whole host of smaller DSPs like Viant and Adherent, et cetera. You got BuzzFeed as a quasi-publisher. You can position it in some ways as an SSP, but that business is not doing great. They have a tremendous amount of financial pressure now that things got real. After 8-9 quarters of being public, shit is getting really real, and they got a lot of pressure. And can they be going concerns? Can they ever produce free cash flow for their investors? Not almost every single one of them is well below their IPO price. And I mean, they're so far underwater. And then that means everybody in these companies that has vested stock, they're all underwater. They got zero incentive to be there. Things start to get weird. That's one point. Another point would be, sorry for the background noise. Another point would be around game theory and auction theory. Okay, what you want to do as a buyer, right? So buyers, I think, are better at understanding sellers and thinking like sellers than sellers are maybe understanding buyers. Maybe there's some equilibrium there. But the point is this: as a buyer in an auction, I always want to bid the indifferent price. I don't care if I'm in a first price auction or second price auction. I'm bidding the intrinsic value that I think it's worth. If I win, I'm so happy, but I'm equally happy if I don't win, because that means I didn't overpay. I'm indifferent to what I bid. Sellers need to be indifferent to their dynamic floor pricing. You need to be indifferent. So I think to who I think it was who was just speaking, who's with the piano in the background? Is it
Yeah, that was me.
Hi, Emery. Yeah, I think that
Tom.
important points about users, because the thing is, who cares about an impression? The first thing when you're trained back in the day at Criteo, where I had some formative experience, you never cared about impressions. You only cared about users. Impressions are nothing. Impressions come from users, assuming they're human, right? So impressions come from users. And so with that, I think from a dynamic floor price perspective, Lila, the way I would think about it is a reverse of the way Criteo does things. So Criteo bids, the eCPM bid price is a function of a CPC times the predicted CTR. So but Criteo has an advantage. Criteo sees lots of users. They've got a hell of an ID graph. So not only do they know the predicted conversion rate of the user, but they also have a relative universe of all users that they've seen. Well, you at a publisher have a universe of users that you get to see. So I'm thinking, if I'm a publisher, I'm thinking about it in terms of, how do I reverse that? In other words, if I were satisfied with a 50-cent CPC, if I'm the CFO, and I run some modeling, I go, you know what, we would be totally satisfied if we averaged out at a 50-cent CPC. What I'm going to send into the exchanges is going to be based on the predicted CTR, and I'm going to submit an eCPM bid that I'm indifferent to into the exchange. And if I win, I win. If I lose, I lose. And hopefully, depending on the size of the publisher, I got a direct sales force out there, selling up as much as possible, in the direct market.
Philosophically, I believe you, or I agree with you, but the problem that I see, especially with performance marketing, and this is Criteo, Nativo, all of them, Lift, AdWords, okay? They're trying to get the lowest CPC possible. And so they're trying to clear the lowest CPM possible all the time to drive their CPCs down. But the CPC they clear is a direct reflection of my CPM. And so if they're getting a 3-cent CPC or something, I mean, that I guess is super low. Let's say 20-cent CPC. I know they'll pay 50.
Yeah, well, they also have a problem now too, don't forget, because of the signal loss. So Criteo, for example, Sociomantic back in the day, but Criteo and other good retargeters, Criteo probably being the best. When I say the best, I mean their engine used to be with cookies, used to be very, very, I mean, the error rate was extremely low over lots of bids. And signal, and that's very important to the model, because you're effectively arbitraging between a CPC and an eCPM, and so, or a CPM buy price. And so when you get signal loss, you get error rate in your predict. And when you get error rate in your predict, you have to get bid lower CPCs basically, because it's just the way it all functions. So a lot going on here.
But we're going back to this because
Yeah.
in the loss of cookies, we're going to be turning towards last click attribution, which is a CPC model. So this becomes very relevant, I believe, post cookie. I've been saying this for a long time. If you can't get the user data, you're going to be driving towards trying to get clicks.
Chris, and then I got to start to wrap this up.
Of course, just mostly because this is conversations we have internally as an agency. So I would say everything you were saying about like the end goal and what they're trying to do was definitely true until this year. This year kind of changed things at the agencies in terms of advertisers started coming to us because stock market's starting to go down at the end of the year. People's consumer buying went down, so many advertisers are saying, "I got to cut our budget, but I can't cut our performance of that budget." So as an agency, then that leads us. Then we need to maximize what we're doing towards actual results, not just clicks or impressions, which used to give them reports saying, look, you're getting a lot for your money. Now they're like, well, what is that click doing? Is it getting me a sale? How much? And not every agency is used to operating that way. And we've definitely saw a huge uptick in our operation. We always did that. It was always backed out to a result, but others. So it has been a fundamental change that we do care about. If we spend $1,000, we don't care if you're Forbes, we don't care if you're abc.com or some random website that we've never heard of. If you're backing out to real sales, we'll put more money there because that's the result we're trying to get to. So it is a more user-driven aspect. We are obviously conscious about brand safety and things like that, and making sure we hit the user at the right place, not necessarily trying to find a user that's not going to be interested in the content at the time. The second issue in terms of this cookieless world and stuff is what's happening is agencies like us, advertisers, we're beefing up our data capabilities. We're building our own data sets because first-party data cookies are not going away. And we're all cookieless now. Most of our technologies are fingerprint-based, whatever. So our CDP operations have scaled significantly. This allows us to track all of our first-party data, and then we make our own analysis, and we know who's buying. So then we use that data. We can share some of that with Google. They'll create a lookalike audience that they'll target for us, or we share it with Facebook. They'll create their lookalike. None of that's going away. What's going away is Facebook's ability to track things that they're not directly in charge of. Google's ability to track things they're not directly in charge of, means cooking users when they're not part of the auction or they're not buying. And that will change things for third parties, the people that don't have these large first-party data sets already in place, such as Criteo, such as PubMatic, Magnite. Who's going to benefit from it? Amazon, who has a massive first-party data set that they share with advertisers. Trade Desk is going to suffer because they don't have that data set. So there will be a change in who's buying from you. But for agencies, we've already hedged the bet, knowing where we're going to be putting our money by building our own CDPs and collecting our own data. So we have our own audiences to kind of overcome that. I don't know how it's going to work and what that's going to affect publishers going forward. I can just tell you that that's what's coming down the pipeline from our side. And our budgets are what pay you guys in the end, right? It comes from us somewhere, somehow. An agency or a buyer is what's giving you money.
Yeah.
That's the moral, honestly. That's where the money's coming from. Like, we have to figure that out and collect that as much as we can. And I think that's important to know. And thank you, Chris, for giving us some insight on that. But yeah, if they're not paying us and the advertisers are indifferent, not seeing it from the DSP, what are publishers doing to make sure that they're getting their piece in that game effectively?
And that to me is, and thank you, because both Chris and Nat are kind of helping kind of pull this together, right? My underlying takeaway, to oversimplify perhaps what we've been kind of discussing, is that there is a need for simplification. If I'm a publisher hearing this, there's an aspect that juicing playing the game of programmatic header bidding, that used to be just fun. Right? You sit there and you try to figure out something like, oh, I could try this, I could try that, like whatever. And it's coming clear that the no longer are just DSPs going to buy whatever shenanigans we come up with. The day of transparency is kind of coming to us. It's up to us as publishers. And I'll go to Alex, kind of what you said toward the beginning is still there. If you have the means, having the relationship is what cuts through all the ad tech bullshit. And the fact of the matter is you work with someone and you want to create those relationships every time. Build your business off your audience and doing right by them, and then turn around and do it right for the buy side. This other stuff, the fact is, that doesn't pay all the bills, certainly for all size publishers. And so we do have to work on all these pieces. But what I'm kind of hearing as an underlying theme is that the complexity of all of this is such that, again, it doesn't probably make sense to throw bodies at this as much as technology, that there's a need across things to find pockets. And to Emery's point and Lila's point, you put a value on it, right? You put that value on it, and that's the signal you want to go out with. But like, there is an aspect of trying to push that and go like, I bet you this $1.33, I can make $1.35. If you think in those terms, you're losing, right? To the point, Tom, about profitability, right? Like there's only so much, right? And so I think that there's, think of it this way. If you're working that hard to get just that little bit of a lift, you might want to look at more of a macro solution. What is my inventory? What could I do to add more value? What can I do in that front? Some of the stuff in terms of the noise of SSPs not passing the right stuff to the DSPs or whatever, there's an aspect that we live in that world, but there's a part where I think, again, I'm not saying we're there for transparency, and I'm not saying that everyone that's offering transparency is doing it without their own incentives, but there is a part, I think we're all starting to understand how all these things are connected more and more. And again, Chris, I'm going to keep giving you accolades. Like Chris is one of the people that's academically working this, right? Yeah. And others are trying to work this thing. And Tom, I've only just discovered your work, and I'm, falling in love with just understanding those pieces, right? There's an aspect where gaming of the system is just not going to work. And I also think there's this last piece of this with the relationship with the SSP. Clearly, if you did not get that sense on this call, is broken. And the publisher side, we got to see what we've done to that. Some of these people on this call have heard me say this way too many times. But when you go to someone to say, hey, you want to be my partner? I want to pay you as little as possible, and I want you to bring as much money to me as possible and go and get other clients and all that stuff. Hey, how come you're not giving me any love? We're part of the issue, okay? You can't just blame everything on the SSP. That being said, we got to sit there and figure out how we go to market. And I feel like that is broken. The incentives are misaligned. And the fact that I can set a floor and that floor doesn't necessarily get transferred to the people that I want to actually see it, that's fucking fraud. I mean, so there's an aspect of us we got to solve.
Rob, to your point, ask yourself this as a publisher. If you could have a genie in a bottle and the genie comes out and everything was all of a sudden perfect in your world of how you want this thing to be, the question to answer is, why would it go back to the way it already is today? And answer that question, and that's where your problem is.
Yeah. Fantastic. I just want to say as kind of a wrap-up point. So first of all, thanks Tom, Chris, and Chris for setting that up. Again, this was our first one. I wanted to try slightly different. Again, this wasn't like, brand new thing, but it really did help the way you did it and all those various facets of that. I want to thank everyone that joined in. The webinar chat just took right off. So some of you will probably be enjoying that. I was not, because I couldn't keep track of everything. But I saw some great points from Mr. Shankman. Nils, you weighed in there. That was great. Julia, you were there. Like, fantastic. So I always want nothing but feedback, what we can do to improve on this. What's the next topic that we take on, right? And start to have these conversations. And again, I wasn't sure that I would have a group like this size all the way for 90 minutes. Don't mean to make it this long, everyone, but we covered a lot of ground. And so hopefully there was a lot of insightful things you picked out of it. Thank you so much. Everyone, just go on and enjoy the rest of your damn day. I'm off to Edinburgh. Tom will be at Navigator. Chris will be at Navigator. Chris Francia. I didn't get Chris Kane yet because he's busy launching all his stuff. But some of you will see a Navigator November. I'm about to fly out to Edinburgh. It's going to be amazing. We're already talking about 2024. So let's keep the conversations going. Thanks, everybody.
Thanks,
Thanks,
Rob.
y'all.